Hello, Assalamualaikum everyone. Okay, for this week, since we have Keamatan and Gawai going, we are going to replace our lecture for this week using asynchronous approach as well. So this is the video recording for chapter 6. Okay, so before that, I would like to wish happy Keamatan and happy Gawai to everyone. Um, I wish you guys are enjoying the celebration and the holiday and hope you guys are healthy and stay safe wherever you are. Okay, so inshallah, I will be seeing you guys in our live lecture next week. All right. Okay, so let's start. Okay, so this chapter is for cost volume profit relationship. Okay, so what is cost volume profit relationship? Okay, so cost volume profit analysis is a technique where you can use how uh, where you can see how selling price, sales, the volumes of your production, the volumes of sales, the cost that you incurred, the expenses, and how does that would affect the profit. Okay, so you will see how these three elements influence each other. Okay, so these are the ways where cost volume profit analysis can be used. Okay, so you can see the effect of changes in selling price on profit. If your selling price increases or decreases, how does that change your profit? And then you can also see the changes in cost on profit and volume on profit, and how do you set the selling price and so on. Okay, so first of all, I would like to show you guys how we will prepare income statement under the management accounting approach. Okay, so previously you have learned how to do income statement in financial accounting, where you have revenue and then you minus with your expenses. Okay, then you will get your profit. But here we will use what we call a contribution format. Okay, so the contribution income statement format will be used for internal planning. So this is used by the internal users and will be useful for our decision making process. So we will use this approach for this chapter, which is cost volume profit analysis, and then the next chapter for budgeting. Okay, so let's look how the contribution format looks like. Okay, so this is how it looks like. Okay, so you have your sales revenue and then you minus with variable costs, then you get a contribution margin. Okay, and then you minus with fixed costs, then you get net operating income. Okay, so this is the difference between the contribution format with what we have previously learned. Okay, so here they separate the cost into two behaviors, okay, which is variables and fixed cost. Okay, so the contribution margin format here emphasize on cost behavior. Okay, so it divide into variable and fixed cost here. So the traditional approach here is on the left side, which is sales minus the cost of goods sold. Okay, so this is for the merchandising companies. Okay, but we learned before is for the service company. Okay, but in the merchandising, in the traditional approach is sales minus cost of goods sold, and then you get gross margin, and then you minus with your expenses, then you get net operating income. So this will be used for external reporting for the external users. So the contribution approach here will be used internally, therefore it will be used by the management. Okay, so sales minus variable expenses, you get contribution margin instead of gross margin, minus fixed expenses, so you will get net operating income as well. Okay, so the first one is explain how changes in activity, okay, affect contribution margin and net operating income. Okay, so under this topic, there are a lot of concepts that you have to understand, and there are a lot of formula going on. Okay, so you can list down all the formulas later on. Then you can have like a summary of the concept and a summary of the formulas. Okay, so we will use Racing Bicycle Company as our example, okay, throughout this chapter. Okay, so we have Racing Bicycle Company. Okay, so now they have sales for 500 bicycles, okay, which equal to $250,000. So it means that one bike equals to $500. And then minus variable expense of 150,000. Therefore, one bike have variable expenses of 300. So the contribution margin is 100, meaning to say that the contribution margin per unit, okay, for one bike only equals to 200. $200. Okay, so minus fixed expenses, which is 80,000. So we don't have a fixed expense for one unit. Okay, it is a total fixed expense. So you will get a net operating income of $20,000. So what is contribution margin? All right, so the contribution margin is the amount remaining, okay, the balance after sales revenue have been deducted with variable expenses. Okay, so you need to know contribution margin equals to sales minus variable expenses. Okay, so it can be um, shown, therefore the contribution margin is used first to cover the fixed expenses first, so we will minus with the fixed expenses. Therefore any remaining contribution margin will contribute to net operating income. So here you see this is a total contribution margin. Total contribution margin means it is for the 500 bicycle. So contribution margin can also be expressed in unit, which is for one unit of the product only. Okay, so here, as you can see here, as I mentioned just now, this is per unit, which is for one bike only. All right, so one sales for one bike is $500, and then minus with 300 variable expenses per unit for one bike. So you get a contribution margin per unit of $200. So it means that if Racing sells an additional bicycle, $200 of additional contribution margin will be generated to cover fixed expenses and profit. Okay, so you will see later on why the knowledge of knowing how much is your contribution margin in total and how much your contribution margin per unit will help you to do the analysis later on. Okay, so for example here, each month, Racing Bicycle must generate at least 80,000 in total contribution margin to break even. So break even means when the company have a profit at zero, meaning to say they are not getting any profit, but they are not losing as well. Okay, so if they want to operate at break even level, therefore they need to have a contribution at least $80,000. Okay, so let's look at the break even. So if RBC sells 400 units in a month, okay, it will be operating at the break even point. Okay, so 400 bicycle times $500, so you'll get a total sales of $200,000 minus variable expense 400 bicycle times $300, so you get $120. So the contribution margin will be 80,000 minus the fixed expense, so you get net operating income of zero, which is equals to profit. So the break even point is at 400 bicycle, 400 units of the product. So the break even sales is $200,000. So break even can be expressed in points, can also be expressed in sales dollar. So if it is break even point, therefore it is 400 units, and then for sale it is $200. Okay, so if RBC sells one more bike, which is 401 bikes, therefore net operating income will increase by $200. So we do not actually need to prepare an income statement to estimate the profit at a particular sales volume. Okay, so simply multiply the number of units sold above break even by the contribution margin per unit. Okay, so this is how the knowledge of by knowing how much is the contribution margin per unit can help you to do a quicker analysis if you want to know how much profit that you will get if you reach a certain sales volume. Okay, so you know that the break even point is at 400. So it means that the profit is zero at this level. So you want to know how much profit that you will be getting if you sell $30 more. 30 units of bike more at 430. Therefore, you can easily say 30 units. You can easily do 30 units time the unit contribution margin of 200. So you will get, you know that you will get a profit at $6,000. Okay, so let's look. Okay, so if you were to draw the income statement, this is how you will draw. 401 bicycle multiply with $500, you get 200,500 in sales, minus variable expenses of 401 bikes multiply with 300, so you will get this one. So your contribution margin will be 80,200. So minus fixed expenses 88,000. So you know the net operating income is 200. Okay, so if you use the this method just now, okay, it's easier rather than you want to draw up the income statement. But I will show you in the further slides. Okay, so before that, we look into the equation form first. All right, so the contribution margin income statement can be expressed in the following equation. Rather than drawing up like this, you can use this formula. So profit equals to sales minus with variable expenses, then you minus with fixed expense. You need to minus with the variable expenses first, then only you will deduct the fixed expenses. So let's have a look. Okay, so 401 units multiply with 500, with 500. Okay, so that is your total sales. And then variable expense 401 units multiply with 300, and then you will minus 80,000. So you will get this one. So you know that you will be getting a profit of $200, which is similar with what is shown in this income statement. So for a quicker result, okay, you don't have to draw up this income statement, but you can use this formula. All right, so let's have a look to the next one. Okay, so this is if you were to break it down, okay, so sales equals to quantity sold multiply with selling price per unit. So sales equals to P multiply with Q. And then you minus variable expense, which is quantity sold multiplied with variable expense per unit. So that equals to V multiplied with Q minus with fixed expense. So if you were to simplify this, you can put it this way. P minus V, selling price per unit minus variable expense per unit, multiply with the quantity being sold. Okay, then you minus the fixed expense. This is how you can simplify this formula. All right, so you can see here. All right, $500 multiplied with 401 minus 300 times 401. Okay, minus 80,000. But then you can also do 500 minus with 300. Then you multiply with 401, so that equals to $200 multiply with 401, then you minus 80,000, and then you will still get $200. Okay, so you can use whichever formula that is easier for you to understand. Okay, so it will still give you a similar answer. Okay, so here, all right, this is the one that I explained just now. up until here. So actually P minus V, as I mentioned just now, equals to CM. Alright, so it depends if you are using total, sorry, it is equal to unit CM. Okay, unit contribution margin. So you can only use selling price per unit minus variable expense per unit, then you will get a unit CM. Unit CM means this is for one unit only. Alright. Okay. So this equation can also be used to compute RBC 200 profit if it sells 401 bikes. Okay, this is the one that I have shown you earlier. But let's say if the question straight away give you unit CM, okay, unit contribution margin, they didn't tell you how much is the selling price, how much is the variable expense. Therefore, you can right away use this one. Okay, you can just jump to the formula without going through um, the selling price and the variable expense first. You can just right away calculate using the unit CM that you know. Therefore, this is how the knowledge of knowing how much is your contribution margin per unit can help you perform a quicker analysis to see how much profit that you will be getting. Okay. All right. So prepare and interpret a cost volume profit and a graph and a graph. Okay, so here is the example. So this is at 0 cells. This is at 200 unit being sold. This is 400, which is at the break-even point. Okay, and then 600. So maybe you can focus on the break-even point here. Okay, you will see the sales is 200. Total variable expense is 120, contribution margin 80, fixed expense is 80. Okay, so all the fixed expenses will be remain constant even though the sales volume differs. Okay, so the fixed expense remain constant whether you are selling 0 or whether you are selling 600 units. Okay, so by using this information, you can draw a CVP graph. Okay, so let's have a look. So in a CVP graph, unit volume is usually represented on the horizontal x-axis. So this is X, and the dollars will be on the vertical, which is on the y-axis here. So first of all, what you have to do is you need to draw a line parallel to the volume axis to represent the total fixed expense. So the fixed expense is 80,000 just now. Therefore, you can just draw a 80,000 here no matter how much is the unit. This is a straight line here. And then the second one is you choose some sales volume. Let's say you choose 400 units. Therefore, you plot the point representing total expenses. You need to add up your fixed and the variable expenses. Then you draw a line. Okay, so let's say at 400 units here, the total expense is at 200. Okay, so you can just draw here and then at 0 level, okay, 0 sales volume, you know that your total expenses is only at $80,000 because you don't have any any variable expenses at this point. So you can connect these 2 points and then you just connect it and draw like this one. Okay, and then after that you will draw the sales line. Okay, so the sales line at 0 is at this point. Okay, at 0 unit, you make $0 when you sell 0 unit. And then at 400 unit, you are making 200,000 sales. Okay, so you plot another here, then you can just draw up like this one. Okay, so at this point, there will be some lines be intersecting each other. All right. So when the sales line intercepts, okay, intercepts with the total expenses lines, that is how you can get your break even. Okay, so the break even point is at 400 units and your break even sales is at $200,000. All right, so this is where you will be getting profit and this will be getting losses. Okay, so it means that if you have if you sell less than 400 units, you will be getting losses. But if you sell more than 400 units, you will be getting profit. Okay. All right. Okay, so the next one is use the contribution margin ratio to compute changes in contribution margin and net operating income. So previously you have learned how to get total contribution margin, which is total sales minus with total variable expenses. And then for unit CM, which is contribution margin per unit, okay, that is selling price, okay, per unit minus variable expenses per unit. So now you can also express CM using a ratio, which is a percentage. So how do you get the CM ratio? All right, so this is total. This is contribution margin per unit. So this is the CM ratio. All right, so the CM ratio is calculated by dividing the total contribution margin, okay, by the total sales. So it is $100,000 divided with 250,000, so equals to 40%. So the base will be the sales. So this cell will be 100%. And then for you to know the variable expenses, you can divide the variable expenses divided with sales 250,000, so you will get 60% here. So your CM ratio is 40% here. So how do we can use the contribution margin using the CM per unit and the selling price per unit as well. Okay, 200 divided with 500. So you will still get a CM ratio of 40%. So the CM ratio can also be calculated by dividing per unit information. So it depends on the situation in the question. If the question gives you total sales, okay, and total variable expenses, then you can still calculate CM ratio. But if they give you CM per unit and selling price per unit, you can still calculate your CM ratio. Okay, so here let's look how CM ratio can be applied here. If racing bicycle increases sales by $50,000, contribution margin will increase by $20,000. Okay, so you can just simply multiply $50,000 with 40%. Then you know already how much contribution margin will increase. Okay, so here is the proof. Sales of 400 units is $200,000. So $50,000 divided with 500, which is the selling price. So you know that means they are selling 100 units more. That's why this is 500 units. Okay, so to get $250,000 sales, you need to sell 500 units. Okay, so the variable expense is $300. Okay, multiply with 500 units, so you get $150. So your contribution margin is 100,000, where sales 250 minus 150, therefore you get $100,000. So minus less fixed expenses 80,000, so you get net operating of 20,000. So a 50,000 increase in sales revenue, okay, 250 divided with minus $200,000 here is 50,000 increase in sales, will result in a 20,000 increase in CM, okay, the contribution margin. So 100,000 minus 110,000 minus 80,000, so that will result in a 20,000 increase in contribution margin. So a simpler term, okay, if you don't want to draw this income statement, you can just right away use the information that you know, which is the CM ratio, multiply with the increase in sales of 50,000, so you know your CM will increase by 20,000. Okay, so that is how powerful how easy that is if you know, if you have the knowledge of this CM ratio, CM unit, and so on. It allows you to perform a quicker analysis. Okay, so you can have a look and try the question on your own. Okay, so this is the formula. All right, so the relation between profit and the CM ratio can also be expressed using the following question. Okay, so CM ratio multiply with sales minus with fixed expenses. Okay, so this is the second formula that you can remember. If racing bicycle increase its sales volume to 500 bikes, what would management expect profit on net operating income to be? Okay, so you know that the CM ratio is 40% just now. Multiply with 250,000, which is 500, multiply with 500 bikes, multiply with $500, which is the selling price per unit. So you get the total sales of $250,000 minus 80,000. So your profit will get 20,000, which is similar by knowing so similar with what you have seen in the previous slide. Okay, so it depends later on. If the question give you the total sales and the fixed expenses and the CM ratio, therefore this is the formula that you can use. Okay, but if they tell you how much is the increase of sales and does not give you the fixed expense and it gives you CM ratio, so you can just use the increase of sales multiply with the CM ratio that you know just now. Okay, so it depends on the question what type of information that they are giving you in the question. Okay, so the next one is show the effect of contribution margin on changes in variable costs, fixed costs, selling price, and volume. Okay, so the variable expense ratio is the ratio of variable expenses to sell. It can be computed by dividing the total variable with the total sales. Or it can be divided with the unit selling price, the variable expense per unit. Okay, 300 divided with the unit selling price of 500, so you will get 60%. Okay, so let's look into this example. What is the profit impact if racing bicycle can increase unit sales from the sales increase from 500 to 540 bikes? Okay, but by um by increasing this kind of sales, okay, the monthly budgeting will be increased of the monthly advertising will increase by 10,000, which is monthly. When it tells you monthly, this means this is a fixed expense. Okay, it means that your fixed expense will increase by $10,000. So how do we calculate when we are given this type of questions? Okay, so you can do it like this. All right, so the sales is 500 units, increase to 540 units. So the sales become 550 multiply with $500. Okay, so you get 270,000 as your sales. The variable expense does not increase, it remains at $300. So you get 162,000 for your variable expense. So your contribution margin becomes 108, but your fixed expense is now increased due to the advertising budget. Therefore, it is 90,000. So the net operating income is 18,000. Okay, so even though it seems like if you are selling more, you feel like that is a good news. Okay, that is a good thing for your company. But when we do this kind of analysis, we found out that when we are increasing our sales, but then we are also increasing our cost. So even though the sales increased by 20,000, but your net operating is actually decreasing. Okay, decreasing by 2,000 from 20,000 to 18,000 because you already increased the fixed expense. Therefore, This is how cost volume profit analysis helps the company to determine whether it is worthy for them to increase their sales. If that would increase the expenses as well, therefore it will impact the profit. Okay, so you need to remember it does not necessarily mean if you are selling more, it means that you are getting more profit. Okay, because sometimes when you are selling more, you will be incurring more costs. Therefore, those costs are bigger than the benefit of selling more, and therefore it reduces your income. Okay, so a shortcut solution using incremental analysis is, okay, so you calculate the increase in contribution margin. You know that the unit CM just now is $200. So you multiply with the increase of sales, okay, which is 40 units. Okay, so the 40 units multiply with $200, so you get $80,000. And then increase in advertising expenses, so you will minus okay, because this is expenses. All right, contribution margin minus 10,000, so you have a decrease in net operating income of 2,000. Okay, so you don't have to draw up the income statement, but if you are unsure, you can always draw up the income statement. Okay, so this is the second example. What is the profit impact if racing bicycle can use higher quality raw material? Okay, they will use higher quality raw material, therefore increasing variable cost per unit by $10. So from 300 before, now it becomes 310. To generate an increase of sales from 500 to 580 units. Okay, so how would that impact your profit? So as you can see here, only the variable cost is increase is change, but fixed, there is no information on the fixed cost. So we assume that the fixed cost remain at $80,000. Okay, so here for five, so 580 units multiply with $500, so you get $290,000 in your sales. So your sales variable expense has now increased. 580 units multiply with 310 equals to 179,800. So your contribution margin increased by 110,000, sorry, increased to 110,000 to $110,200 minus your fixed expense, which is remained at 80,000. So the net operating income increased to 30,200. So as you can see here, the sales increased by 40,000, 290 minus 250 here, and the net operating income increased by 10,200. Okay, you can see 30,200 minus 20,000, so the net operating income increased by 10,200. Okay, so in a way, it helps you to make decision whether it is worth, whether it is better for you to use the quality raw material, even though it will increase your variable expenses, and by using the higher quality, you can sell more of the units, and then you will also be obtaining a greater income. Okay, so this analysis helps you to make that kind of decision. Okay, so the next example is, what is the profit impact if RBC cuts its selling price 20 per unit? Okay, so it means that the sales at 500 now become 480. And then it will increase its advertising budget 15,000 per month. So therefore, your fixed expenses increases, okay, which is from 80,000 to $95,000. Okay, and then increase sales. So the sales will be from 500 to 650 units. Okay, so this is the scenario. So let's have a look. Okay, so 650 units, you multiply with 480, which is the new selling price. And then your variable expense remain the same. So 650 units multiply with 300 per dollar. And then you get a contribution margin of 117,000 minus your fixed expense, which is now increased to $95,000. So your net operating income increased by 2,000, becoming $22,000. So the conclusion is your sales increased by 62,000, okay, which is 312,000 minus 250,000. And then your fixed cost increased by 15,000 and your net operating income increased by 2,000. Okay, so you can decide whether this is a good thing for your company or not, whether it is worth it for you to do this kind of scenario. Okay, and then the next one is, what is the profit if they pay a 15 sales commission per bike sold? Okay, instead of paying salesperson flat salaries that currently total 6,000 per month. So now they are trying to say, okay, why don't we pay sales commission per bike sold rather than paying a fixed monthly salary for the salesperson of 6,000? So what happened here is that your variable expenses now increases because it is based on how much you need the bike will be sold. Okay, so your variable expense from 300 is now becoming to $315. And then your fixed expenses will decrease by 6,000. So from 80,000, then now it is reduced to 74,000 because you are no longer paying the salary of the salesperson. And then the sales is from 500 units becoming to 575 units. Okay, so let's have a look. Okay, so the sales is 575 units multiply with 400, sorry, 575 multiplied with 500, okay, which is the normal price. And then for the variable expense is now at a new rate, which is 315 multiply with 575 units. So you get $181,125. So your contribution margin is 106,375. Your fixed expense is now reduced by 6,000 to 74,000. So you will get an income of 32,375. So you can see the sales increased by 37,500, which is 287,500 minus with $250,000. Your fixed expense decreased by 6,000. So net operating income increases by 12,375, whereby you can deduct 32,375 with the old net operating income of 20,000. So you get this amount. Okay, so then you can decide whether this is a good thing for the company as well after you have done this kind of analysis. If you think that this is worth, then you can go for it. But if you don't think that this is a good increase, therefore you don't have to change anything. Okay. And then the next one is, if RBC has an opportunity to sell 150 bikes to a wholesaler without disturbing sales to other customers, so it means that it will not disturb and the normal sales to the other customer, and it will also not disturb, it will not increase or decrease the fixed expense. What price would they need to quote to the wholesaler if it wants to increase monthly profit by 3,000? So in this matter is a bit different. You know that the sales need to increase by 150 units, but now you know the fixed expense remain the same. And then the monthly profit you want to increase by $3,000. Okay, so how do you do? All right, so 3,000, this is the target profit divided with 150 baht. So you will have 20, you will need to charge $20 more for the bike. Okay, because you want to get this profit. This is the profit that you want. So $20 per bike is the target profit per unit for each of the bike. And then you know the variable cost is $300 per bike. Therefore, the selling price required will be 320 per bike. Okay, so the selling price is 320, no longer at 500. Okay, so you can see here 150 bikes multiply with 320 per bikes. This is the new selling price for the extra additional 150 bike here. So you will get a total sales of 48,000. And then your total variable cost for this 150 additional bike is 45,000. Okay. Then your increase in net operating income will be 3,000. Okay, so this is how you can see how we can set the sales price. All right, so determine the level of sales. Okay, so this is the next one. I believe we still have two more after this. Okay, the level of sales needed to attain a target profit. Okay, so we have two types of equation, a method here. One is equation, one is formula. It is the same. It's just that the way how they rearrange the elements in this equation or the formula is a bit different. Okay, so we can compute the number of units that must be sold to attain a target profit using equation or formula method. Okay, so you have learned this formula just now. Profit equals to unit CM multiplied with the quantity being sold minus fixed asset. So you know the profit. Okay, you know how much profit that you want. You know the unit CM already, but you do not know how much you need to sell in order for you to get the profit that you wanted. And then you minus your fixed expense. Okay, so let's have a look here. Suppose racing bicycle management wants to know how many bikes must be sold to earn a target profit of $100,000. So RBC wants to get a profit of 100,000. Okay, so the profit is $100,000. The unit CM is 200 per bike. You do not know how much you need to sell. Then you minus 80,000, which is the fixed expense. And then you rearrange everything so that the quantity sold is on the left side, and then you will get 900 of units. Okay, so it means that RBC need to sell 900 bikes in order to get a profit of $100,000. Okay, so this is the equation method. If you use the formula method, personally, this is easier for me. Okay, I believe that formula method is much easier as compared to the equation because they already rearranged the element just now. Okay, to have the Q, sorry, have the Q on the left side. Okay, so actually it is the same. This is profit plus fixed expense divided with CM, unit CM. Okay, so it's just similar with profit equals to unit CM divided multiply with Q minus fixed expense. Okay, so everything is similar here. It's just that in the formula method, they already rearranged so that this Q will be on the left side. Okay, so similarly, the answer will be the same. It's just easier. It's just less messy, I would say. Okay, so unit cell. Okay, so you can just plug in all the information here. 100,000 plus 80,000 divided with 200. So you still get a similar answer of 900 bytes. Okay. All right. Okay, so here, this is the second formula that you learned just now. Okay, it is using CM ratio and cells. Okay, so similarly, equation method, you want to know how much cells. Okay, so here it depends on the question. If the question asks you for a unit, you need to use the first formula just now. If if they are asking for cells, you use this formula. So I would like to highlight here, if you remember, there is a trend. Okay, if the answer is asking in terms of unit, you will use unit cell. Unit CM. And then, okay, but if the question is asking answers in cells dollar, you will be using CM ratio. Okay, so that is the difference. When the question is asking, the answer is expressed in units, you use unit CM. Okay, let me show you one more. Okay, so if they are asking you in terms of unit, how much the quantity needs to be sold, you will use unit CM. But if they are asking you in terms of sales dollar, you will use CM ratio and then you multiply with sales. Okay, so don't be confused. Okay, let's say you are confused. How do I know if I want to use the formula 1 or this formula 2? Okay, so it depends on the question. Okay, so if the question is asking, let's say here, RBC management wants to know the sales volume that must be generated. Okay, so the sales mean this is a dollar. Okay, let's say if the RBC management wants to know how much quantity need to be sold, that means they are asking the answer in terms of unit, expressed in units. Okay, so here similarly, okay, you just plug in all the information. This is 100,000 here. The CM ratio is 40% just now. Sales is, you do not know how much. Fixed expense is 80,000. And then you rearrange everything, so you will get a sales of $450,000. So which mean equals to 900 units multiply with $500. So you will get $450 sacks in total. Okay, so similarly you can use the formula method, which is easier, as I mentioned just now, because the cells is already on the left side, so you just have to plug in the same thing, but you just still need to remember, if they are asking for dollar cells, you use CM ratio. If they are using unit cells, so you will use a unit CM here. Okay, so don't be confused on that. Okay. All right. So next one is determine the break-even point. Okay, so this is the one that I mentioned just now. A target profit needs to be 0. Okay, so easy, very easy. The profit here will be 0. So you know the unit CM just now is 200, and then you do not know how much is the Q, so you minus with 80,000, and then you rearrange everything, then you will get 400 bikes. Okay, so this is if they ask you for a break even units, the profit will be a 0. Okay, so this is the formula method. They are asking you the unit cell, so you use CM per unit, which is much easier. You just divide it with 80,000 with the CM unit 200. There is no profit here. Okay, there is no profit because the profit is 0. So they do not include the profit in this equation. They already take it down because it doesn't matter if you put profit there, the amount will be still be 0. Okay, so if they are asking for break-even sales in sales dollar, so you use CM ratio, multiply with the sale. Again, the profit is 0. CM ratio is 40%. You do not know how much is the sales. And then you minus with 80,000 for the fixed expense. Okay, so you get $200,000 after you rearrange. Okay, so similarly, it's easier for you to use the formula method, in my opinion, because the dollar sales is already on the left side. Okay, so fixed expense is 80,000 divided with 40%. Again, there is no profit element here because the profit is still 0, so it doesn't relevant to be included in the formula here. So you will get $200,000 as well. Okay, so it depends on the question, what kind of information that they give you, then only you select which formula you can use, and then if you like the formula method, you use formula method. If you like the equation method, then you use the equation method. Okay, all right. Okay, so this is the second last one, the margin of safety. What does it mean by margin of safety? um Let me pause a bit. Okay, so this is the second last one, margin of safety. All right. So what does it mean by margin of safety? So margin of safety in dollars is the excess of budget or actual sales over the break-even volume of sales. So it means that what is the extra sales before they hit the break-even sales? Okay, so as you know just now, the break-even sales is at 400 units, which equals to $200. Okay, so let's say the total sales they incurred is $300,000. So $300,000 minus $200,000, so they have margin safety of $100,000. Okay, so it means that the margin of safety in dollars here is $100,000. So it means that they can still lose $100,000 before they hit loss. Okay, before they experience loss. If they reduce, if they decrease, sorry, if they lose 50,000 of sales, they will still be operating at profit level. Okay, but if they lose, let's say $120,000, so it means that they already experienced loss because it is more than $100,000 of the margin safety already. Okay. Okay. Um. All right. So if you assume that RBC has the actual sales of $250,000, given that we have already determined that the break-even sale is $200,000, so the margin of safety is 50,000. Okay, so it means that they can still if they lose more than 50,000, then it means that they already have will be experiencing loss. Okay, so margin of safety is the balance of the actual sales minus the break-even sale. How much they can lose before they start to operate in the loss. Okay, it can also be expressed in terms of percentage. Margin of safety can be expressed as 20% of the sales. So 50,000, you need to know how much is the dollar margin of safety in dollar first. Okay, then only you can express it in terms of percentage. So you know it is $50,000 margin of safety just now divided with 250,000. So you get margin of safety in percentage of 20% of the sales. Okay, and then it can also be expressed in terms of units. Okay, so the margin of safety is $50,000. So $50,000 divided with the selling price per unit is 100 bytes. So it means that before you can, the margin of safety can be expressed in dollar, in percentage, and in unit. Before you can calculate percentage and unit, you need to know how much is the margin of safety in dollar first. Okay, so you can try to attempt the question on your own. Okay, so the last one is the degree of operating leverage. Okay. Um, Okay, so compute the degree of operating leverage at a particular level of sales and explain how it can be used to predict changes in operating income. So what does it mean by operating leverage? So operating leverage is a measure of how sensitive of the income when the sales changes. Okay, so operating leverage can measure how, if your sales change, how sensitive your income will react to the changes in the sales just now. Okay, so the degree of operating leverage, how do you calculate it? Okay, contribution margin divided with the net operating income. Okay, so here you have sales of $250,000 minus variable expense 150. Okay, so your contribution margin is $100,000 and then your net income is 20,000. So divided, you get 5. So the degree of the operating leverage is 5. Okay, so with an operating leverage of 5, if RBC increases its sales by 10%, therefore the net operating income would increase by 50%. Okay, so this is a quicker analysis. You know that, okay, if I increase my sales 10%, my profit will also increase by 50%. All right, so this is the proof. Okay, we draw up the income statement. If the increased sales is 10% just now, okay, 10% times 500 units, so you get 50 units extra. Okay, so the increased sales is 550 units. And then all of this, after you calculated, okay, you can see 20,000 of the actual sales. When you increase the sales to 550 units, you get a net operating of 30,000, which is increased by 10,000 units. So these 10,000 units result a 50% increase, 50% increase by the 20,000, which is the actual sales, is 10,000. Therefore, it increases 10,000. So now the net operating income will be $30,000. So that is how you can use the degree of operating leverage. Okay, so you can try this on your own later. Okay, so what does higher value of operating leverage mean? It means that it signals the existence of high fixed cost. Okay, and then it increases risk of making loss in adverse market condition. Also increase opportunity to make profit of higher demand exit. So it means that we do not want our operating leverage to be too high or too low. Okay, we just don't want it to be too high, because if your operating leverage is too high, it means that your profit will be very sensitive to any changes in your sales. Okay, if your sales changes drastically or significantly, therefore your net operating income will also be affected significantly. All right, so these are the key assumptions of our CVP analysis. The selling price is constant throughout the analysis, and then it is very easy for us to distinguish variable and fixed element. Whereas in a real life situation, business situation, probably it is a bit harder for us to classify our costs into just variable and fixed costs. Okay, so some company have mixed cost. Okay, so in a way, if there is a mixed cost, therefore CBP analysis would be a bit more complicated to be performed. And then in multi-product companies, the sale mix is constant. Okay, we assume that um uh when we have, as what you have seen now, you are only doing CVP analysis for one product. Okay, so if you have um multiple product, therefore the CVP analysis will be a little bit more complicated. And then if you still have a multi-product company, you mean that the sales mix is constant, you know that how much product that you have. But if you are producing new products every year or every month, every year, okay, therefore the CVP analysis will be more complicated. Okay, probably um it wouldn't be good to perform. Okay, because it keeps on changing. It might not give you the real life a real prediction. Okay, a better prediction. And then the key assumption also, whatever that you produce, you will sell every single thing. Okay, so as I mentioned just now, if a company sells more than one product, break-even analysis becomes more complex. And then different product will have different selling prices, cost structure. It could be variable, it could be fixed, it could be mixed cost as well. Therefore, probably if a company sells multiple product, therefore CBP analysis will be very complicated to be performed. Okay, so that's all for this chapter. If you have any question, you are welcome to text me anytime. Okay, so if you have any problems in doing your tutorial, then you are welcome to talk to your tutors. And then you can also ask me if you want. Okay, probably in this chapter, what I want you to focus is you need to know what are the formulas that you need to do. Okay, so you need to know what is the question asking. Question is asking what? Whether it is unit or whether it is dollar. Okay, so if it is unit, you use unit CM in your formula. If it is dollar, you use CM ratio. So you need to know what is unit CM, how to calculate CM ratio, okay, what is break even point, okay, and then the target target profit, the break even, the margin of safety. Okay, so margin of safety have margin of safety have dollar, okay, percentage, and then have unit, and then DOL. Okay, so all of this is the one that I want you to focus on. All right, okay, so that's all for this chapter. Thank you very much for watching and listening. Okay, if you have any question, don't forget and don't be shy to contact me. All right, okay, I see you guys next week. Assalamualaikum and goodbye, everyone. Thank you.